Hello, everyone, and welcome back to Market Brief After Hours. It is Monday, and if you've been watching the screens today, you know there wasn't a whole lot of green to be found. We are looking at a sea of red across U.S. equities as a pretty potent combination of fears took hold.
That's right. It was a classic risk-off day. We saw investors running for cover as two major narratives collided. On one side, you have the geopolitical tension with President Trump's renewed push for global tariffs. On the other, and perhaps more surprisingly, we had a resurgence of fear regarding artificial intelligence, specifically how it might actually disrupt established corporate giants sooner than expected.
It feels like for the longest time, AI was the magic word that sent stocks up. Now it seems the narrative is flipping to who gets left behind. But before we dig into the why, let's look at the damage on the main boards. The numbers were stark.
They certainly were. The Dow Jones Industrial Average took the brunt of it. It plunged 822 points. That's rounding to the nearest whole number, or about 1.66%. It closed at 48,804. That is a significant slide. The S&P 500 wasn't spared either. It fell back into negative territory for the year, dropping 1.04% to close at 6,838. And the Nasdaq Composite, which is usually the high flyer, dropped 1.13% to finish at 22,627.
So the S&P is actually in the red for 2026 now. That is a psychological blow for a lot of investors. You mentioned the Dow took the heaviest hit. Was there a specific catalyst there?
There was, and it ties back to that AI anxiety I mentioned. IBM was a massive weight on the index today. The stock fell nearly 13% to around $223. This happened after Anthropic, an AI competitor, announced their Claude Code product. The claim is that this tool can automate complex analysis and modernization of COBOL systems. Now, for those who don't know, maintaining those legacy systems is a huge business line for IBM. Suddenly, the market is asking, if AI can do this cheaply, what happens to IBM's revenue?
That is a fascinating shift. It's no longer just about who builds the chips. It's about whose business model gets eaten by the software.
Exactly. And that fear rippled right through the software sector. It wasn't just legacy tech. We saw Microsoft down 3%, and CrowdStrike slumped nearly 10%. The market is worried that rapid AI adoption might undermine demand for established software subscriptions. If an AI agent can write code or secure a network, do you need as many seats on a SaaS platform? That's the question driving the sell-off in the Nasdaq.
So we have the tech disruption on one hand, then on the other, we have the White House. The tariff talk is back.
It is, and it's escalating. The administration is pushing for a 15% global tariff policy, and it looks like it's set for immediate implementation. Markets hate uncertainty, and this introduces a lot of it. We are seeing immediate geopolitical fallout, too. The European Parliament announced they are pausing work on ratifying the US-EU trade agreement in response. That kind of friction hurts sentiment for global growth.
Speaking of Europe, let's hop across the Atlantic. I assume the mood wasn't much better there given the trade news.
Mostly lower, yes. The tariff risks are front and center for European exporters. The Pan-European Stock 600 was down nearly 0.5%. Looking at the specific country indexes, in the UK, the FTSE 100 slipped just 6 points to close at 10,681. It was relatively flat. France's CAC 40 fell 17 points to 8,499. The big loser was Germany, likely due to its manufacturing exposure. The DAX dropped 269 points, or 1.06%, to close at 24,992.
Germany taking a hit makes sense if trade wars are looming. Was there any bright spot in Europe?
Surprisingly, Italy. The FTSE MIB actually bucked the trend, rising 226 points to close at 46,699. And it is worth noting that despite the market drop, the economic data from Germany was okay. The IFO Business Climate Index hit 88.6 in February, the highest since last August. So the businesses feel okay, but the stock investors are worried about the politics.
Let's move to Asia before we take a break. Usually when the U.S. sneezes, Asia catches a cold, but it sounds like there was some resilience there.
It was a mixed bag, but yes, some real strength in places. South Korea was the standout. The Kospi surged 1.7% to hit a fresh record high. That was driven by the chip makers. SK Hynix was up over 3% and Samsung over 2%. They seem to be benefiting from the AI hardware demand, even as U.S. software stocks struggle with the implications. Hong Kong's Hang Seng was also strong, jumping more than 2%.
But not everyone in the region had a good day.
No, Australia's ASX 200 fell 0.6% to close at 9,026, dragged down by real estate and energy. And just for clarity, markets in China and Japan were closed for a holiday, so we didn't get a read from Tokyo or Shanghai today.
Got it. We are going to take a very short break. When we come back, we need to talk about where investors are hiding their money, because it certainly isn't in Bitcoin today. And we'll break down the currency moves that are happening in the background. Stay with us. Welcome back to Market Brief After Hours. We've covered the equity sell-off, but usually when stocks drop this hard, money has to go somewhere. Let's look at commodities. Was oil a factor today?
Oil was remarkably quiet, all things considered. It seems to be caught in a tug of war. On one side, you have the tariff fears, which could slow global growth and hurt demand. On the other, you have easing geopolitical tensions in some areas balancing that out. Brent crude slipped just 0.29% to $71.55 a barrel, and WTI was effectively flat, edging down slightly to $66.42.
So oil is steady, but looking at the precious metals board, that looks like a full-on stampede.
Absolutely. This is the classic flight to safety. Gold is behaving exactly how you'd expect in a high-fear environment. It surged 2.51% to close at a staggering $5,236. It broke decisively above recent highs. And silver did even better percentage-wise. It jumped nearly 5% to close at $88.83. When investors are scared of tariffs and tech bubbles popping, they buy hard assets.
Now, usually, crypto enthusiasts argue that Bitcoin is digital gold. Did it act like gold today?
Not even close. Bitcoin slumped. It fell below $64,500, trading as low as $63,885 at one point. It's now down more than 24% year-to-date. In a risk-off environment, crypto is being treated as a high-risk asset, not a safe haven. We saw that bleed into crypto stocks, too. Coinbase and the miners were all down sharply.
That is a tough reality check for the crypto market. Let's shift gears to Forex. With the tariff news and the flight to safety, the currency markets must be technical battlegrounds right now. Walk us through the major pairs. And I know our listeners appreciate the technical levels, so let's include those moving averages.
Sure. Let's start with the euro against the dollar. It actually held firm, closing up slightly at 1.1789. The key here is the technical support. The pair held above its 50-day moving average, which sits at 1.1772. As long as it stays above that, the near-term support is intact. It's also well above the 100-day average at 1.1689. So despite the trade tension, the euro is holding its ground.
What about the British pound?
Sterling is in a bit of a consolidation phase. GBP USD closed at 1.3492. The ceiling right now is the 50-day moving average at 1.3529. It just can't seem to break above that. However, support is holding at the 200-day average, which is at 1.3444. It's trapped between those two averages right now.
And the Aussie dollar? Usually that's sensitive to global growth sentiment.
It is, and it pulled back. AUB USD fell 0.34% to 0.7056. It failed to hold above the 0.7100 level. However, looking at the technicals, the broader uptrend is still there. The price remains comfortably above the 50-day, 100-day, and 200-day moving averages. So this looks like a consolidation after a rally, rather than a reversal.
Finally, the yen. With yields dropping in the U.S., did the yen strengthen?
It did. USD JPY closed lower at 154.70. It's stabilizing, but it is trading below both its 50-day moving average, which is at 155.92, and the 100-day average at 154.90. That signals some weakness in the dollar against the yen. If it breaks below support at 153.99, we could see a deeper drop.
Thanks for that deep dive. Before we wrap up, we have to look at the specific stock movers. We touched on IBM earlier, but there was massive news in the pharmaceutical space today.
Huge news. It was a tale of two drug makers. Novo Nordisk shares sank 16%. Their obesity drug, CagriSema, failed to match Eli Lilly's treatment in a head-to-head trial. That is a massive blow to their pipeline. Conversely, Eli Lilly shares climbed nearly 5% as they solidify their dominance in the weight loss sector.
And it wasn't all doom and gloom. We saw a massive pop in the biotech sector regarding an acquisition.
Yes, Arcellx. The stock surged more than 77%. Gilead Sciences agreed to acquire them for $7.8 billion. That's about $115 per share.
It's one of the largest healthcare deals of the year, and it really woke up the sector.
And quickly, I saw PayPal was near the top of the leaderboard.
It was. PayPal rose more than 5%. The rumor mill is churning there. Reports suggest they have attracted takeover interest from several potential buyers. No deal is signed, but where there is smoke, investors are betting on fire.
So looking ahead to tomorrow and the rest of the week, we have the 15% tariff policy looming. We have US-Iran nuclear talks potentially restarting. What is the vibe on the street?
Caution, extreme caution. We are seeing Treasury yields fall. The 10-year dropped to 4.03% because investors are parking cash in bonds. The market is bracing for volatility. They are waiting to see if there is retaliation against these new U.S. tariffs, and they are waiting to see which other software companies might get hit by this AI automation narrative. It is going to be a bumpy week.
Well, we will be here to track it all. It's certainly a complex picture right now. That is all we have time for today. If you find this useful, please follow Market Brief After Hours. We'll see you tomorrow.